All right. So I am sitting with a new friend of mine, Zach Beach. You have been investing in real estate for what, 10 years or more?
Yeah, it's actually going on 10 years. So December of 2014, I started making my first dials.
Nice.
Yeah, so now we're going on, towards the end. So not quite 10 years, but almost there. I felt like it's been a heck of a lot longer. I promise you that.
Yeah, yeah. So especially with all the ups and downs and all the stresses that can come with it. But
Oh, for
um, so you have been investing. You have been doing creative finance before creative finance was cool, like you say. Before it became super mainstream.
sure.
Due to a good friend of ours, Pace Morby, has definitely made it more people more aware about creative finance. You are also the CEO of Smart Real Estate Coach. This is, I'm assuming, a coaching program of yours.
For sure, yeah. So, yeah, CEO of Smart Real Estate Coach, where we actually show people how to buy and sell real estate with creative financing, so sub twos, lease options, owner finance, and then how to exit on rent to own in our with our three payday system.
Love it. Okay. And then where are you originally from?
Right here in Central Massachusetts. I was born and raised in Shrewsbury, Massachusetts, and then actually I went off to college in Boston, then went to UMass Dartmouth, the real, Dartmouth, and then
I'll disagree with that, but that's okay.
oh, for sure. That's why people. I was always telling them, I'm like, I went to Dartmouth.
uh,
Like I was like, yeah, UMass Dartmouth. And then moved to
I,
Newport, Rhode Island. Lived there for almost 10 years, from basically when I was 21 or 22 when I graduated, up until last year when I was 32 years old. And then we moved back to Shrewsbury, Mass, to raise our kids. I got a 4 and a 6-year-old, and me and my wife both grew up here, and we thought it was a really good place to have everyone grow up.
Tell me, you might have just already said this, but why did you originally move to Rhode Island?
Yeah, good question. So, my wife's family, where because my wife and I met in middle school. It's actually tomorrow is going to be our 10th anniversary from being married, but 21 years of us being together, which
Wow.
is kind of insane because
Right.
I spent more time with her than I have without her at this point in time. And thank goodness, because the Zach without Kayla gotten a lot of trouble.
Mhm.
Um, the so we moved to
I
Newport.
agree, by the way.
Yeah, so we moved to Newport, Rhode Island because my wife's family bought a second house down there, and when we graduated from high school, they moved down there full time. And I honestly was just looking for a new place to settle. I grew up in Central Massachusetts. A lot of my friends went to Worcester State, stayed here, and I needed a change. I went through a lot of challenging situations growing up, battled with addiction and a lot of other things as well. So I needed a new place to start over. So when I left UMass Dartmouth, me and Kayla said, we're not going back to Worcester. Instead, why don't we move to Newport and let's try something new? So then we moved down there, actually stayed with her parents for about 6 months. And then eventually we ended up getting our first apartment down there. And then I started bar backing, and then eventually bartending. And then helped open up a new restaurant down there as a bar back and a bartender. And my wife ended up doing the same thing. And then we were in that restaurant or the industry life for almost 4 years. And then I was doing that and personal training down there. And then Advocare, I was, hustling nutritional supplements as well. So I was doing whatever you needed to do in order to make money. And then eventually I got super burnt out. And that's what started getting me thinking about real estate.
Okay. So you were multiple jobs. You were doing sales already, but was it Advocare you said?
Yeah. Yep. Advocare.
So that obviously involves a lot of sales.
Yeah.
The
Network
life of
marketing.
I've been in someone who's been in sales for over 10 years. I can definitely relate, just like the hustle and things like that.
Sure.
So what led you? So you would you at that point were you just kind of like thinking, all right, I need to figure something else out so my life is not so chaotic, or what led you into the real estate investing space?
Yeah, I was just getting burnt out. I was 24, and I was working late nights every single night, at least 4 or 5 nights a week, because
Yep.
bartenders we start at least in my place that I worked at, I was primarily working night shifts, as that's where you made all the money. So I would get in at like 4 or 5 o'clock,
Yep.
and then set up the bar, have a little bit of break, and then work until 1 o'clock in the morning when things closed. And then, it takes you an hour to break down the bar. So I'm home at 3 o'clock. And then I have basically a 2-hour window to nap. And then I had 5 a.m. training clients. So then I had 5, 6, 7, 8 o'clock roughly training clients. Then I would go home and then I would power nap all day, or power nap, right, for a while.
Mm-hmm.
And then when I started adding in real estate, I then would be making phone calls from like 12 to 2 in the afternoon as well. So I just started fitting that in. So really, I was just getting super burnt out. And if you've ever been in the industry, if anybody's watching this that's been in the industry, and I say that as the real, like the bartending industry, hospitality, you really have two choices. You either are going to stay in the industry, which means that you're going to have to look into being management because eventually you want some sort of a normalcy of a life, or for me, being entrepreneurial, I mean, I started selling golf balls when I was like in 3rd grade. Me being entrepreneur, I needed to start thinking like, oh, well, now I got to figure out how to go raise money and own a restaurant. So that was like my 2 paths in which I had considered, because I wasn't going to be a bartender forever. And it's not that I'm against that. It just wasn't my lifestyle. As you can imagine, there's lots of different challenges that come with that, good, bad, or indifferent, being a bartender. So I had to basically make a decision. So I knew I didn't want to stay in the industry. So I need to start looking elsewhere. And that's what started to lead me to MLM companies like Advocare, because I was like, okay, maybe I can start getting really good at that. And then eventually I approached my father-in-law, who's my business partner in a couple of the businesses we own, especially in Smart Real Estate Coach, who he founded. And he got crushed in 2008. So he just started this new business called buying and selling on terms, right? Creative financing, buying real estate with no money down, no credit, no personal guarantees, no banks. And I knew he was like a year and a half in. So I approached him and said, hey, I don't know if I'm going to like real estate, but it's going to be better than what I'm doing. Are you open if I started working in the company for a little bit? So that's when I started making phone calls. And I mean, when I talk about phone calls, like I just got handed a list of names, right? Expired listings, maybe 300 names. And that was probably for a couple weeks. And I was handed a 1-page document that was called Commonly Asked Questions. And then I was handed a property information lead sheet, which all that really is just a bunch of questions that I need to fill in answers to in order to discover whether or not this is going to be a good fit for me to buy or a good fit for the company to buy. So that's exactly where I started, was from the ground up. I was not being paid. I was basically a virtual assistant for free labor. Then eventually I started to get better, and then I started to be maybe a little bit overpaid virtual assistant. And then eventually, I started to become a real estate investor. And then I started to be able to at least get profit share from the deals in which we're coming in. And that's how we've always built out the company. We get paid, we eat what we kill. So we all get paid once we do a deal. So that's kind of the way the process started escalating.
Well, real quick, backing up just a tiny bit. So when you first got introduced, when you first started working for his company, you just didn't, I'm assuming you just didn't like cold turkey quit all your jobs, right?
Yeah.
So you squeezing this in at different parts of the day, like, all right, discipline, this amount of hours, this is what I'm doing per day, so I can consist until I start getting traction. Like, what was the trajectory there?
Yeah, great question. So, as I mentioned, like I was doing bartending at night, personal training in the morning, and cold calling in the afternoon. And I did that for about 4 or 5 months, or say 3.5 months. And I started to get some really good traction right around April. And I was about to actually get my first deal. I bought my first Subject 2 deal up in Jefferson, Massachusetts, or it's Holden, also is known as. And at that point in time, I had made enough money consistently through Advocare. I think it was like $2 or $3 grand a month. Between me and my wife, we were making. So we were starting to make enough. And my wife actually made the jump first. She became the office manager for the company. And then I kept working until basically the end of April. And at that point in time, I actually quit all my clients and quit my entire bartending, because I didn't have much overhead at the time. So a lot of people, when I get asked on these podcasts, like, wow, that was, huge. And yes, it certainly was. I knew nothing about real estate other than cold calling at that point in time. But I also was in a point where I was 20-something years old. I didn't have a ton to lose. So when you in perspective, right, I could always go back to bartending. I always got asked consistently, but I just knew that if I was going to actually make this work, I needed to fully commit.
Yeah.
So it was less about, the risk, which there certainly was a lot of it, but it was more about me betting on myself. And the only way I could do that is if I had full focus on learning this, because I had a huge learning curve that I had to overcome. So I knew if I could put 40 hours a week without being exhausted from working all night, that I was going to be able to move faster. And as soon as I did that, we ended up popping my first deal that I went from start to finish, a subject to deal. And then, it just started snowballing from there. And then I went to doing, a couple deals a month, and then fully lead acquisition of the entire company, doing 4 to 6 deals, on the road, 1 to 2 days a week, looking at properties and generating between me and VAs like anywhere from 30 to 50 leads a week.
I love it. How was when you were initially starting out, you were given the list, what was the profit share like when you did acquire any deals? Did they just pay you a fee like, here you go, good job? Or would you guys do some type of profit share?
Yeah, good question. So the way in which we exit our deals is through rent to own, which is, first of all, it's a non-refundable deposit. So we all get paid on the non-refundable deposit, and then when the deal's cashed out. So I think I started like 7.5%. Like, it wasn't very much. And then eventually, after maybe my 10th deal, and I could be misremembering this, as Roger Clemens says, maybe 12.5%. It wasn't a lot. Because we used this to still fund the business. We were bootstrapping it. So our cash flow was going to managing the business as well at that time. Plus we had some overhead. I think I was taking like 12.5% of non-refundable deposits, which was basically like, a couple grand a month at that point.
Yeah. I mean, a couple grand a month on top of what you're actually, you were, I don't know if bartenders, are they W-2 employees? Either way, a couple grand a month for a lot of people on top of their jobs is actually like very helpful for their lifestyle. So
for sure, yeah, it was helpful. But then I quit, so then I had to do deals, right? Then it became, so if I was making $2,000 a deal, I needed to do 2 to 4 deals a month in order to cover my overhead. At that time, maybe I had like $4,000 a month in overhead. Mostly it was rent and drinks at the bar. Before I had kids, we had a dog. That was about it. I think it was like $1,200 was my rent. So at that point, it's not like I needed a ton, but I still had to produce consistently, which, when you first get started in real estate, it's a lot. It's certainly,
like you said earlier, you eat what you kill. So
yeah, certainly challenging for sure.
Yeah. All right. So, now getting into some of like the main nitty gritty, I guess, of your strategy and what you've been doing for the past 10 years. It's funny because you started off doing this type of stuff where people kind of evolve. People start off the typical, like myself, fix and flipping or buying holds through cash flow. And you're just like, nope, right into creative finance. So explain to us what is creative finance, what it basically means in real estate, and then how does it differ from traditional financing methods?
Yeah, for sure. All good questions, right? So, and let's unpack it. But before I get started, and that is, I talk to people all the time, and they always tell me, I'd like to do creative financing. And I ask them exactly that. I'm like, what do you currently do? They're like, oh, wholesaling, or I'm a realtor, or I do fix and flip. And I always ask them, like, so why don't you just start doing creative financing then, if that's what you want to do at the end of the day? There's a straight path. It's just go do creative financing. And most people just have this, I guess, naive, or, I would say the word ignorant, right? Fact that they have to do all these other things. And the truth is they don't. See, I was lucky enough in this world that I was so naive that I thought real estate investing was creative financing. Like, that's what I knew. I didn't do a single fix and flip before I started. I didn't do a single wholesale before I started. The only houses I've ever bought on my own through traditional banking are my own properties. Like, I didn't know. And at that time I was renting, and I actually bought my first family house on a lease option because I wasn't bankable. So luckily I was naive enough. So if you just listen to this, like, you can just start doing creative financing deals. It's actually less complex than most wholesale deals. Like, there's less people involved. It's you and the seller, right? It's you and the seller, and you structuring the terms of the deal. And if you're doing a lease option, it's like you're not even dealing with a closing at all either. You're just controlling the property. So, but as we kind of navigate into this, there's a couple different ways in which we buy on creative financing. So, or on terms, depending on your age group, right? If you're like 40 and 50, it's buying on terms. If you're like 30 and 20, it's buying on creative financing. Just the old school gentlemen's like, Ron LeGrand, everything was terms. And nowadays everything's creative financing.
Yeah.
So the main strategies are we have lease options, which are basically just controlling an asset without ownership. Just I agree to take over any and all responsibilities. I agree to lock in your equity today at a certain price point. I agree to make all of your payments, manage everything, and then at some point in time, I agree to cash you out. And then with the intent to sublease.
Okay. Also known as rent to own.
Yeah. So when I buy, I usually say lease purchase.
Mm-hmm.
It sounds more official to a seller. It sounds more concrete.
Mm-hmm.
When I sell, I usually sell on rent to own because that's just the language that's always been there. People just know I rent and then I own. With a seller, I'm like, I am purchasing your property. I'm just using this lease purchase agreement to go ahead and structure that deal.
And in both instances, it's the same documentation.
One of the documentations is a little more intense than the other. As you can imagine, it's the buyer one, meaning when I sell it to somebody, because I am taking all of the responsibilities from the original agreement that I had, and I'm now passing along all the responsibilities to this end buyer. So all the protection clauses are in my buying document. Okay. All of my protection clauses to the buyer all in this document. So that's also known as a sandwich lease, right? So money flows from basically the buyer to me to the seller or the seller's bank. Mm-hmm. And responsibility flows basically from seller to me to the buyer. So if you just kind of look at, that's how the operation works. Okay. So that was one of the, even though I started out with a subject to deal as my first deal, and I'll talk about that in a minute, a lease purchase transaction tends to be one of the most simplest way to get involved in creative financing or buying on terms, because you can do it all DocuSign. You don't have to even involve an attorney if you choose not to. The one major piece that you need to have in place in this structure is called a notice of option, or a memorandum of real estate, depending upon where you are in the country or what state. And all that simple document is a notarized document that allows you to file a lien against the seller's property to ensure that they don't go sell it to their uncle while you're under agreement, while you have a tenant buyer in the house.
Got it.
So that's a lease purchase strategy. We made hundreds of thousands, if not millions of dollars on that strategy in itself. But no, like that is I want to call it like a beginner strategy in a way, because you're still dealing with active income. You don't have a lot of tax benefits associated with lease purchases. So know that you are going to get taxed a lot heavier on that because you have no ownership. You're just controlling the asset. Okay. The advanced strategy, what a lot of people talk about here today, are going to be buying properties on owner financing. Now, that strategy is one of my favorite ones, given that there's roughly 30 to 40% of all the properties in North America are debt-free, which is a huge group of people in which we target for seller financing. Now, when I say seller financing, like in a pure sense, means there's no mortgage on the property, which means that now me and the seller are going to structure the terms of the agreement together. So we'll close on it. Then the seller will then have a first position, a lien on the property, right? They'll be holding a mortgage, and then you and the seller will create the terms of that mortgage. So you're going to agree upon what the price is going to be, the monthly payment. Is it done in installments? Is there an interest rate? Is there a down payment involved? And what's the length of the time? Is it a full amortization, or is it a payment each and every month and then a balloon that's due? So all that's now constructed, which this is why you can create significantly more profits when you're doing these creative deals, is because you're actually creating the terms of the agreement, not the bank. This is how we get no money. This is how we get no money down deals. This is how we get 0% interest rate deals when it comes to these structures, because you're dealing directly with the seller themselves. And again, same intent is to sell on rent to own if it's a single family property. If it's a multifamily, then strategy is to improve that property and, of course, cash flow it and eventually sell it or refinance if that's what you have to do. certainly if you guys are buy and hold investors out there and you're watching this is just another acquisition strategy to do more deals. Just create the terms associated with your exit strategy. So if I'm a long-term buy and hold buyer, then I am creating long-term terms, even if I have to give an interest rate. Mm-hmm. Versus if I'm a rent-to-own seller, right, or rent-to-own buyer, then what I'm doing is I can create shorter terms and do 0% interest because I know I'm going to cash out the seller within 3 to 5 years. So I don't need to incentivize them to have a 30-year mortgage. I just need the right terms for a short period of time so I can make money off of this particular deal.
Oftentimes when I'm explaining it to people who are not as, investor savvy in real estate, I let them know basically instead of getting a bank involved in creating the terms to use to buy this house, you're turning the seller or the current owner into the bank and saying, hey, let's discuss terms that are amenable for both of us.
For sure, right? Because all you're essentially doing is creating an IOU, right? An IOU is going to create the terms of the agreement, and then the mortgage is then going to be the instrument that ties the IOU to that property. Mm-hmm. And now the seller, there's tons and tons and tons of benefits, but the seller is so protected in this circumstance because every bank wants to be in first position. So if you're talking about limiting liability for a seller, they are in first position on an asset that they know, like, and trust, and they're getting paid top dollar on this, or interest or income on an asset that they know, like, and trust. So that's a huge, huge, obviously, benefit for them. And now for you, you don't have to go get a bank loan. So now you can now take on an asset that you don't personally guarantee, that you don't have to go get a bank loan on, and now you can start creating cash flow on that particular property.
Okay. All right. So we have lease option, we have owner finance or seller finance. What's the next?
World famous, right? Subject to deals.
Subject to.
The funny thing is that most people just assume, right? And it's kind of a pun there because we're not going to assume anything, but they're going to assume that it's subject to is just for subject to the existing lien or existing loan on the property. Well, you can buy a property subject to anything. Now, are you able to get title insurance on it will be a completely different scenario, right? That'll be different. But in theory, right, subject to deal, all that means is you're approaching a seller that has a current mortgage on the property. Now, this could mean that they could have no equity, which is obviously a great seller. Or this could also mean that they do have equity, which means that you'd be acquiring it subject to the first lien on the property, but then you would then create a secondary mortgage for the seller, and there'd be seller financing that component. It's a little bit of a mixed bag there. So if I'm just looking at like a pure, just to completely, diversify here, a pure subject to deal, little to no money in equity. If they sold the property, they would have to come out of pocket or they're behind on payments. And now you're stepping in, you're going to close on the property. You're going to then maintain or cover the current mortgage that's in place. That mortgage will still remain attached to the seller's credit. And then you're just making monthly payments until in which you cash that property out. I always tell people if you're buying a property with little to no equity, two things need to happen. One is the market has to appreciate. Now, if you're selling on rent to own, you can already manufacture equity. Because I can sell to somebody in 3 to 5 years from now at a higher price than what I bought it for, even if the retail market today says it's only worth this amount, at what you bought it for. Secondly, you also need the mortgage balance to go down, right? So that's why the number one asset right now and why everybody's talking about subject to deals is because there's lots and lots and lots of low interest rates. It's roughly, I think it's like 85% of all loans in the United States are 5% or less. Or 4/5, the countries are 5% or less.
Bye to those. Yeah. You probably won't be seeing those again for a long time with new loans. Yeah,
for sure. And we could talk about how these interest rates even today are affecting, the other side, the exit strategy here in a minute. But there's still, there's still 4/5 United States that have those loans. Now, I could go out there and raise hundreds and hundreds and hundreds of millions of dollars and still we'll still have millions of properties that have those low interest rates. So that's a huge advantage right now as you as a real estate investor, if you know how to structure these things and do it morally and ethically and properly, because there's lots of opportunities out there for low interest rate loans. And there's lots of people right now that are willing to sell their property with those low interest rate loans because of death, divorce, financial challenges, real estate challenges. And now all you got to do is be that calming voice that will come in and help them transition and whatever is happening in their life. I can just tell you, just in the state of Massachusetts, I've acquired a couple real estate deals subject to, because of the taxes have increased so much in the last 3 years since the original buyer bought it, that they no longer can afford that monthly payment. You know, if somebody buys a house for $1,400 a month, and now all of a sudden it's $1,800 a month, that affordability or their monthly income is not increasing as quickly as the taxes are going up. So lots and lots of huge opportunities right now for you to come in, and I don't want to use the word savior, but for you to come in and really be a problem solver. And of course, you're going to benefit from doing so. So, you know, those are the three main strategies that we use.
3 main acquisition strategies. So, you know, what's funny is when I was like first getting involved in understanding the lingo behind real estate, people were say, "Oh, like, what's your acquisition strategy? What's your and I was like, I kind of understand it, but I kind of don't. I was like, okay, acquisition strategy. How do I acquire? And there's like another way to think about it is like, how am I getting these properties? How am I obtaining these properties? Is that's the strategy? Is one of them is going to be subject to, the next one's going to be owner or seller finance, and then lease options.
Yep.
But also, you can use lease options as what to do after you've already acquired it.
Yeah, 100%. And then you also can do right now is you can use those terms in which we just talked about, and you can assign those terms to somebody as well. I know that's extremely popular right now, and I love those investors because I don't have to go find some of these deals. I just pay somebody to go do so, especially if you have some private money or you have some extra capital coming from other deals. You can get into these deals for very low, down payments, because somebody's just going to go tie up a subject to deal, put the whole thing together, and then sell it to you for $10,000, $15,000. And now you don't have to go find them as well. So that's another opportunity too. So if you're sitting there like, all right, well, if I got a deal and the seller wants money down, or there's a wholesaler involved, or there's a realtor involved, and I don't have the money to get into it, tie up the terms and then go find somebody like myself and have somebody purchase it, because there's definitely a need for that right now as well.
I wish I would have known you. I did my first subject to deal, I would say around September of 2023, give or take. And I ended up assigning it to a friend of mine who's going to move in there with his girlfriend. But knowing what I know now, I probably would have kept it for myself and done a lease option, and probably would have, milked it a little bit more. But that's okay. We got future ones coming. So
there's lots of them coming right now.
Yeah.
Love it. If I'm talking about my exit, in my mind, I'm really doing one or two things. If it's multifamilies that we're buying creatively, then I'm buying, holding them, improving them over time, and then keeping those. That'd be the ideal, or eventually sell them. But if I'm in the single family space, which a lot of people, that's where they start, it's very unlikely I'm going to buy and hold it unless it has significant cash flow on it, because I buy within like a 2.5 hour radius. Being right in central Massachusetts, I'll buy up to as far north as New Hampshire, to all the way down south to like New Haven, all the way to Rhode Island, in that radius as of right now. But also with Smart Real Estate Coach, we buy in 80 plus markets. So really, it's hard to get a property management company when you're so spread, instead of a very specific targeted area, because in the space that I'm in, I'm buying real estate based upon the terms of the agreement. I'm not necessarily based upon the area, the location, population, like all of that stuff. Like those are secondary factors to me. First and foremost, it's the terms of the agreement. Then it's the condition of the property. Then it's like the location. But I can tell you that when I'm selling on rent to own, it almost doesn't matter, because I am probably the only person, if not one of a very select group of people, that is selling a rent to own property in a majority of the towns and or cities, and wherever I'm located and that property is located. So, and that eliminates any type of management. So when I say that, The condition of the property will be secondary after the terms, because I already know that I can cash flow it. I can sell it for a higher price. I already understand it before I even go to see the property. So that's why we're primarily exiting there. It would have to be near perfect in order for me to just rent it, or it'd have to be very local to where I'm at to rent it, just because I don't want to manage it. Or if I am going to manage it personally, I want to be able to be in a relatively close area if I'm going to self-manage. But that probably better cash flow like 800, 900,
Yes.
$1,000 in order to keep it.
For it to be worth your time. Yeah, 100%. So and the reason being is because when you're doing lease options, are you not managing them properties?
Yeah, so on a lease option, I have zero man. It's like as passive as you can get in real estate investing, other than being like a passive investor in like a syndication, right? Or a private money lender or something like that. Like, as far as being a real estate investor themselves, when I acquire a piece of real estate, I am now going to pass along any and all responsibilities to that end buyer. So they are treated like and they act like a homeowner. That's why they come in with a non-refundable deposit day one, which is anywhere from 3 to 10% of the overall purchase price, either upfront or over time. They're then going to pay a monthly rent payment, which will be above and beyond what my expenses are. So now I got monthly cash flow. And then they're going to manage that, and they're going to help me pay down the debt on the property as they pay me my cash flow. So one day when they go get their bank loan, they'll then cash me out. So I am completely hands off. That's how I'm able to buy in all these different markets, because it's not that I have to actively manage or hire management companies to pay attention to me, right? Because it's like, if you have 10 doors or less, they're not going to pay attention to you. And even if you have 20 doors, they're still not really going to pay attention to you. It's not until you actually have a good amount of buildings that now you can actually go hire a decent property management company. So we just decide to, pass along all the responsibility to the tenant buyer.
It's also like you said though, but if you have, let's say, 30 doors, but they're all spread out all over the place, it makes it much more difficult to find one property management company.
Yeah, you got to go hire 30 of them.
Yeah,
and they have one door now, and they're not going to pay attention to
you. Yeah, 100%. Okay, so next question that I do have then is, what are the benefits of a lease option, both for the investor and also for the seller/owner of the property, current owner?
Yeah, so selling a property on a lease option, lots of benefits for the investor. You get the non-refundable deposit, so you can pull profits forward, right? It's up to like 20% of the profits you make on that deal, or 30% are going to come from the non-refundable deposit. So you can pull profits forward today instead of waiting for them. You can get cash flow on it. You're going to build an equity into a deal, and you don't have to manage it. So you're dealing with a different level of a person when it comes to a tenant buyer, somebody that's interested in becoming a homeowner, versus a tenant. Who treats your property better, the homeowner or the tenant? It's always the homeowner. So they just have a different outlook and perspective on the property in which they're living in. They're improving it. They're treating it like it's their home because they're expecting it to be their home. They're investing in it. So that's obviously major benefits. Benefit for the actual tenant buyer themselves. They get to lock in a price today. They get to live in a home while they save more, while they improve their credit. Once they go close for the loan, they're already living in the property. There's no moving out of this house in order to move into the other one and going all across the, managing all of the interactions and all the different craziness that comes to buying a property. I know when I bought my own house, like I sold one in Rhode Island roughly the same week as I bought one in Massachusetts. Now I have to do this whole moving. They're already living in the house.
Yeah.
And then, of course, while they're living in that property, they're improving it, which could also improve the value. They also, if it's required, and also they're saving more too. So that way, if they need to go get, or when they go get a loan, they're able to get a better loan versus probably the loan that they can get today. Because we have lots of people that today are buying, they have good credit, they have good income, but they don't have a debt to income ratio that works for a 7.5% interest rate or a 7% interest rate. So instead, they live in the property with us, and then we can only assume that in 3 years from now, it'll at least go down to like 6, 5, right? So now they'll be in a better position to actually get a better loan in the future.
Or maybe their debt to income drops and qualifies them in 3 years.
Yeah, or if we're buying it subject to or owner financing and we have long terms, I can always sell it on a wrap mortgage. And now they never have to go get a bank loan, or at least that extends now another X amount of years for them to wait for the market to shift.
Okay, perfect. All right. What are some common misconceptions or challenges that people face when they're using lease options?
Yeah, well, there's always lots of. I would say there's always the big misconception in general, right? And I'm like speaking more towards like consumers. When you speak to a seller, right? There's you get some rebuttals like, oh yeah, we tried that, or my uncle tried that, or my cousin tried that one time.
But they
The
didn't really.
reality is they probably didn't do it right because they're not treating it like a business. They're treating it like a secondary option because they weren't able to get what they hoped to either get for a purchase price, or they were hoping like I don't have to be a landlord, but I still get all the landlord benefits. Like there's a lot of misconceptions there. So when we do it, it's a systematic process that has multiple third parties in it that specialize in certain things. Like I'm the investor, I play my role. I don't play the credit repair role. I hire, we actually direct somebody that's a credit repair specialist and that used to write mortgages, and they'll come with a mortgage readiness date. We hire the attorneys in order to help them make sure that the paperwork is completely set up for both of us and that the buyer actually signs in front of the attorney. We ensure that they have a non-refundable deposit that's worth them like actually putting their feet to the fire. Like we're not accepting 2%, 3%. Like we're accepting typically 3 to 10% upfront or over time. But I want them to feel the pain as if they have to default on this agreement. That's how you increase the amount of people that convert to actually becoming homeowners, because you have to put that feet to the fire in order to make sure they're successful. So that's a major and then of course I'm not the mortgage lender, so we actually bring in a mortgage lender in order to help them eventually close the deal. So that's important that everyone plays their role. This is a team game. It's not I'm a landlord, give me a monthly payment and one day you can buy my house. Of course that's never going to work because you're not actually affecting the key behaviors of that tenant to then become a buyer. They're tenants for a reason. They have a certain perspective, they have certain behaviors that have them be tenants. Right? Certain outlook. If you're looking to convert somebody from a tenant to then a buyer, then they need to save up money. They need to put money down on a property. They need to be focused on their credit. They need to be checking their debt to income ratio. They need to be taking care of the property. They need to be handling contractors if the toilet breaks. Like they need to be trained in such a way that eventually when they actually go get their home, they're now homeowners. They've transformed into becoming homeowners.
Yeah.
And that doesn't happen by just giving somebody the option to buy it someday in the future.
That, and then also asking them for like a 1 month rent deposit or something. It's just not as binding. That's probably not the right word, but not as much of a commitment. There you go.
Yeah, for sure. Or what I commonly see is you pay rent, it's this amount, and then you're going to pay me like an extra $100 a month, and that goes towards your down payment. Like, that could be a part of the process. Like we've done many times where it's you come to the table, we sell the property for $300,000. You come to the table with 10 grand down. The monthly payment is $2,500, but you make 12 grand a month. So you want to contribute another $500 to $1,000 a month towards your down payment. So that way over 12 months, now we have $24,000. That is part of the process, but it's not it can't be the entire process. There's also a lot of challenges that come with rent credits too, because there's like certain things in which the mortgage lenders need to consider, like what's fair market rent. So a lot of people, what they'll do is they'll be like, all right, it's a rent to own program. Traditional rent's $1,500. We're going to charge you $2,000 a month, and we're going to credit 25% of it, right? But there's a lot of measurements in which the mortgage company needs to look into in order to define, is that rent credit actually viable for a mortgage company to now go ahead and give somebody a loan? So instead it has to be very definitive. Like, here's your rent payment, here's your contribution to your deposit or your non-refundable deposit. It has to always be written down, and it always has to be in separate checks or
I was just going to ask, separate transactions, I'm assuming, to make it clean.
Well, and it has to be sourced too. Like, you can't just be like, I just found $1,000. No, it has to be like, I made this money. I'm contributing another $1,000 from my bank account, from my savings, because that's where my check goes, or whatever that may be, and then I'm contributing. It has to be very clear, so that when we go to the mortgage lender at the end of the day, or in 3 years from now, 2 years from now, whatever that may be, we can clearly identify they made this payment, here's where it came from. They made this payment, here's where it came from. They made this payment, here's where it came from. It all has to be sourced, so that way they, can count it towards their down payment.
Love it. Okay. I'm sure you have many over your 10 years experience, but can you share a success story of a property that you did a lease option just to create value in the property, where maybe you created value, but maybe you also helped the family or something?
Oh yeah,
there's tons.
Yeah, there's just as much success as there is challenges. I'll tell you that in general. So yeah, I would say I'll just go based upon some of the more recent deals in which we've done. But there's obviously a ton of success stories in which happened. A majority of the time in which we see our success is those that were renting, and actually were generational renters, and we absolutely changed their lives based upon they're now building equity in an asset that they would have never thought that they were actually going to be able to have ownership. There was a woman, she bought a duplex from us down in Tiverton, Rhode Island. She works multiple jobs. She's from out of the country. She has a maid service. I think she has like a landscaping service. And she had a very heavy cash business. But she was never going to really actually qualify for a loan based upon her current, status.
Uh-huh.
So instead, she came in and she put down a significant amount of money down on this. She then moved her family in upstairs. She moved downstairs, and now she has ownership in a house in which she can now live in instead of bopping around from rental to rental. And she was working extremely hard. So and now that duplex in Tiverton, Rhode Island, I think we sold it for like $250. I think it's gonna be worth like $450 now.
Wow.
Just based upon the market. So it's absolutely amazing how you can drastically, increase people's lives by simply providing home ownership, which is what every American wants, right? The American dream is to eventually become a homeowner. So, and it's unfortunate that roughly 80% of the market out there that wants to be a homeowner cannot become a homeowner based upon rules and regulations from the mortgage industry. Mm-hmm. So instead, we're just providing that, that path to home ownership with this particular lady, but with hundreds of other ones all across the country.
Love it. On that particular property, how did you acquire that? How did you obtain that property?
We actually acquired as a subject to deal. I think we acquired it for like $156.
Okay.
Guy relocated out of state, couldn't maintain the property. It definitely needed a little bit of work. But we went ahead and that was actually a lady. She was the second owner. We had originally another homeowner that moved in there. Talk about challenges, right? Mm-hmm. We had an original tenant buyer that moved in there. There's up, down duplex. To the left is then a 2-car garage. They actually framed out the 2-car garage. And then they had an entire weed manufacturing happening out of Tiverton. Because it's right on the, Fall River line, Tiverton. So that was happening, and then eventually we got notified that was happening, and then of course they lost their non-refundable deposit, and then they had to move, and then we had to go and do a little bit of work to deframe and pull everything down, and then we sold it to her, and then she went ahead and moved in as well. So with subject to deals, because there's no end date, right? All of our agreements state that at some point we will pay it off, but there's no definitive end date. We have ownership. We're just going to maintain that mortgage until we cash them out. So when challenges like this happen, we just now go work with somebody else, take property back over and go work with someone else.
Real quick, I wanted to ask you this earlier when we were talking about the 3 acquisition strategies and one of them being subject to. So we're essentially taking over someone's mortgage, leaving the mortgage in place. So the key thing is, and I hear people say this all the time, is we're not assuming their mortgage.
Yeah.
Purchasing is subject to the existing mortgage. Now, one of the most common questions that one will get when they even bring this up is, what happens if you don't pay my mortgage?
Yeah. Oh, yeah. Well, let's be real. And a lot of the time, so there's I just had a conversation with a seller yesterday. I'm working on a deal right in central Massachusetts. Spoke with the seller, and he said, hey, there's actually going to be some trust between you and I in this transaction. And I said, you're 100% right. I said, if you are not going to be able to sleep at night because I'm making your monthly payment, then we shouldn't do this deal, because there is a absolute trust factor. Now, this particular seller is in good standings. He's not behind on payments. He doesn't have a lien on the property. He's just relocating. And he sees like there's a major benefit because he can relocate quickly. He doesn't have to, he just expired off the market. He was on the market for, I don't know, maybe 90 to 180 days. So now he has to, his thought is, all right, well, now this could be another exit. It could happen off market. I could save money from paying a realtor. And now this guy can step in and maybe give me a little bit of moving money. And then in the future, I'll receive the rest of my equity. But in some circumstances, right, like the seller doesn't really have a choice. And I say that lightly because their alternatives are not good, right? The alternatives are, and of course they have a choice, but their alternative choices are not as good as the offer that I'm presenting. Correct. I just know that for a fact, right? So I can catch up your mortgage. I can then, because I'm a professional investor, I can then make your mortgage payments on time. I can then increase your credit because it's attached to your mortgage. And now I'm actually improving your credit. Or I can catch up your lien or pay off your lien, or I can help you so you don't have to pay a realtor 5% in order to sell your house out of pocket. So there's like some of these circumstances we are the best option. Yep. So there still has to be a lot of trust, but there's also not as much of a downside than the other options to the seller, right? Because if a seller's already running behind on payments and their choice may be like go to a short sale or sell to me subject to, like there's really no option. Like there's a clear outline. I can either help you one day become a buyer again in the future by me catching up your payments, me taking over your loan, and then me improving your credit over time, and then eventually selling this property. Or you could go the short sale route, which is going to absolutely destroy your credit for the next 3 to 5 plus years. And as we were mentioning at the event that I was speaking at with you, you could also be liable for some of that loan, even though they're selling it on a short sale. So there's so much more downside than there is to have some faith in an investor like myself or you, John, to just make sure we keep up your payments. Now, there's also other ways in order to protect the seller as well. So a lot of people don't talk about this, but let's be frank. If you buy a property subject to the existing loan and you actually don't put a wrap mortgage on it or a mirror mortgage on it, the seller technically has zero recourse.
Zero recourse.
So you can do whatever you want. The seller's got zero recourse, so you have no position to foreclose. So if the seller really needed protection, or the way I look at it too is if the seller ever wants to be a homeowner in the future, and you may not cash out this property on time for them to do so, then that seller needs to show that their mortgage is being serviced by somebody else. So a wrap mortgage is a great opportunity to go ahead and do so. So just knowing like morally and ethically as being the investor, being the authority, you have to know too, because it's not going to be much different for you, whether it's a wrap mortgage or it's just subject to deal. It's just another piece of paperwork that the attorney is going to put together. You just morally and ethically need to understand what else is going to be happening in this particular seller's life over time as well. So that way you can make sure you're setting them up for success as well. So those are just different ways in which you can protect the seller. But a lot of that has to do with positioning, right? Mm-hmm. If a seller asks me like, hey, I can't trust you to do this, or what, like the exact question you asked, the way I positioned was don't do the deal then. Yeah. Like just don't do it. And when a seller hears you say that, they don't hear me begging for the deal. They don't hear me saying, oh, like promising the world. I just tell them, if you're not comfortable, then let's not do this. Yeah. I can share with you ways in order to help you make yourself more comfortable, but I need there to be trust today. So what I usually tell them is, and what we should do is before we close this deal, why don't we go ahead and meet in person so that we get to know each other, especially if the property is not, you're not virtually buying it all across the country, which you could also set up a Zoom call and things like that. But there's ways to establish trust. So that way they're saying, okay, I'm ready to trust this person with my credit.
So with that mirror wrap that you were talking about as a protection layer for them to be able to have recourse, if that is in place, and let's say worst case scenario, for whatever reason, all the negative dominoes fall and Murphy's Law comes into effect, their recourse, would they be able to foreclose on you? Since is that basically what would happen?
Yeah, because essentially what they're doing is they're putting them in a position to foreclose because they have a mortgage on the property.
Okay.
Right.
Perfect.
And all the mirror mortgages, just in case you've never heard this before, right? It's just a creation of a new mortgage that the attorneys will put together. That is the exact same amortization, timing in the amortization, interest rate, everything. It just mirrors the current mortgage that's with the seller that is servicing the original loan.
There you go. And if you've never heard of this, do not always make sure that if you're ever going to do these types of transactions, you always need to get a transaction coordinator and a closing attorney who has experience in doing these types of transactions.
Yeah, for sure.
Yeah, I would never do one without. So, I mean, I've heard of people trying to do their own substitute transactions without a transaction coordinator, without an experienced closing attorney. I'm just like, why would you ever put yourself in this position?
Yeah, yes, I agree. At a bare minimum, you got to educate yourself though too, because I always had an office manager. Like right now, I don't have a transaction coordinator. Me and my wife just handle it. We're doing like 2 to 4 deals a month. It's nothing wild or crazy, and I just coordinate with the attorney. In the future, I'll certainly get one. But if you have the step-by-step checklist, which we can certainly provide to you, then at least it's like, I got this thing done, I got this thing done, I got this thing done. Like if you can't afford right now, maybe it's your first deal or your first couple deals, make sure you at least got a mentor and you got some people overseeing your transaction, even if you're not paying a transaction coordinator. Just make sure you're with someone that's experienced.
Definitely. What advice would you give to someone who's considering using lease options as a strategy for investing in real estate?
No, I always tell people, like, if you're not using creative financing deals, you're missing the boat right now, whether it's lease options as an exit or it's lease options as acquisition or it's sub 2 or owner financing. Like if you're an active seasoned real estate investor right now, you are missing out on deals because you just don't know how to structure these current ones, or you're choosing not to. And it doesn't take many deals in order to recoup your marketing budget or to make some additional profit, or so if you're like wholesaling, or to start getting depreciation on an asset and stop paying the government 30 to 40 cents every single dollar you make. Like there's reasons to just make additional offers. Like there's just some times in which a seller may not take, if you're a wholesaler, a seller may not take 60 cents on the dollar, but they may take 100% over time. And okay, well now you didn't think about making that offer and now you did, and now you captured a deal. So just imagine being able to capture one additional deal a year, how much it would drastically impact your portfolio over the next 30 years. It's an absolute no-brainer. And all it is just adding an additional strategy to your current acquisition and or disposition.
Where are you finding the bulk of these deals?
Yeah, expired listings are amazing. Other creative financing investors that don't want to actually close deals, they just want to wholesale them for fees. Realtors, things that and a list I'm targeting right now is active listings with little equity, because you know that agent is going to run out of time at some point. So I want to make some friends. Facebook groups, networking groups, FSBOs. Yeah, they're all viable mailings right now. Pre-foreclosure mailings have been really great. Now, know your pre-foreclosure laws. So I'm not telling you to mail them and say, I know you're in pre-foreclosure. No, you just say, I'm interested in buying your property. And then though, that they have some financial challenges. And if the challenge is high enough, then they're going to call you back faster.
Got it. How do you determine whether or not a property is like a good candidate for a lease option?
Terms. So what I'll always do is I'll look at it. I'll say, okay, well, is the purchase price good, right? Do I have room in order to sell on rent to own, or am I buying the property at a good enough value today where I know I can make profit in the future? So that's one.
If I can interrupt. So It's actually not the property itself, it's the terms of said property.
Always.
You said this earlier, but I'm repeating, which I love. So it's like, because a lot of people was like, well, how do I know if this house is a good viable option for a lease option? It's like, it's actually not the house, it's the terms.
No, they do it. So I'll give you an example. We bought a property with a community member of ours down in North Carolina. And the property didn't even have copper in it. Didn't even have copper in it. Because this guy it was a vacant house, like recent vacant, and they had break in and they stole all the copper. So the guy was like screwed, right? The seller. So he said, well, we'll take it under agreement on, I think we did a lease purchase agreement on this. Or it could have been a sub two, I forget. This was maybe a couple of years ago. We bought it because the terms of the agreement worked out, and then we sold it on a handyman special to a contractor that instead of going to get a giant bank loan, they just started putting money into the property, had an option on the property, gave us some of the non-refundable deposit, and then he improved it. And then eventually, I think he ended up making over $100,000 off the deal, but we got a non-refundable deposit. We cash flowed it while he was improving it. So all the risk was on him while he was doing that, and all the money was on him. So that it happens. Right now, I have a property that, I was supposed to close last month, but it keeps getting pushed back because the sellers are going through divorce. So we had to make sure they have adequate housing. And I think we're just putting this thing together. It's actually coming from your group over there too. I was communicating with our mutual friend Tony, and he's got a property for rent. And I'm hoping that this particular seller, the husband, is able to tap into that property. So, but this property needs a whole bunch of work. It's been basically the sellers have lived in it, but they haven't done anything into it since they bought it. So we're selling it as more or less a handyman special or equity special, right? But it's the only property in this particular area, like on the market for rent or for sale. So they're going to go into the property. They're giving us, I think it's like $20-some thousand over the course of like 24 months or 36 months. They're buying it for roughly retail price here today, and her and her family are just going to improve the property over the course of the couple of years before they eventually go get that loan. So condition is secondary. Terms is most important. Because what I did was, and you'd be surprised. So these sellers went through 3 loan modifications over the past couple of years. So this interest rate is actually 7%. Now, most people would say you can't make money off a 7% interest rate. Well, sure. You can. Because my total all-in payment on this is like $221. I think it's like maybe $22,200 per month. I can't talk.
Not 22,000, 2,200.
Not 22,000. I'm like, that's a massive house. Yeah. $2,200. We're renting it for like $2,750, or the monthly payment is $2,750. Because right now in today's market, I can sell a property on a rent to own for less than what people are going to get a mortgage for. Because the same person, if they bought this house at $350,000 at the current interest rate of 7%, they're going to be paying like $3,300 all in. So they're actually they're paying less money, which means they get to save more money while they go through it. And I'm making like a $250 or a $300 spread on this deal as well. And I got a private money investor in it right now. I bring on some friends and family that will come in and put the down payments down in reserves, which in this particular deal was going to require like $25,000.
Now that investor, that equity partner that you have now has equity in the deal, so they're getting some of the cash flow and some of the non-refundable deposits throughout the length of the lease option.
Yeah, I call them a capital partner. As you start to do more and more of these deals, I mean, don't get me wrong. For the first 10 years, 95% of the deals I've done were no money down deals. But now as we're growing and scaling, and certainly I'm working with some people that have capital, we can now take down more deals in a shorter period of time. So I brought on a capital partner for this particular deal. I think they're in it for like $27,000, and they'll make a good amount of money. They're making 8% preferred plus 50% equity in this deal. So that way we didn't have to use our own capital. And it's going to be a great deal for everyone involved.
Love it. What would you say? Are there like any like key things to consider, or like any pitfalls to avoid when you're structuring a lease option deal?
Yeah, all the different creative financing deals certainly have their ups and their downside, right? Your biggest risk is going to be if you got to put money down on the deal, right? Because the non-negotiables can and should be, I'm not going to personally guarantee debt. I am not going to go to get a bank loan, right? So the negotiables now are price. If you need to put money down, that's going to be associated with it, and then time frame. So the way I always like pan things out is if I'm going to typically put money down on, like, say, a sub 2D or owner financing, I want long terms. I don't want short terms, because if time creeps up on you quickly and you can't get out of the deal, now you are liable for the amount of money that you put into it, because you're now, like, you at least need to make the investor or yourself whole, right?
Yeah.
So that's your biggest liability. So you need to figure out a way to get the seller paid off and get your money back out. So if you're putting money down and a good amount of money down, make sure that you give yourself plenty of time. So, for example, in that deal that I was just talking about, $25,000 in, it's a subject to deal. I don't have an end date. So, worst case scenario, I just keep renting this thing. I continue to communicate with my investor. We just continue to own the property, right? Because they're getting some benefits. So I'm
the
feeling
life of the mortgage, right? For the life of the mortgage.
I could be, yeah, which is a brand new mortgage.
Mm-hmm.
Not that I want to hold on to a 7% mortgage forever, but I got 30 years now if I truly needed it.
Yeah.
Yeah. So that would be the pitfalls, right? You just gotta make sure the terms of the agreement, and then of course, right now, just like any single person in real estate investing right now, the market is, we don't know. Like, we had COVID market.
Mm-hmm.
We had a market private before that. Now we have quote unquote, like, hot market. There's just everything is, and then everybody's worried about if the market's going to crash. Like, so you just don't know. So your biggest protection again is going to be your time frame or length of time that you have on these deals. So just be careful if you're doing too short of time frames. Not with your buyers. Your buyers should always be shorter rather than longer, because you want to control the option. Mm-hmm. Like, if they need an extension, great, give them one if you have no end date or you don't need to get the money out of it. But your actual time frame with your seller is really important, because that's where you need to actually exercise your option, or need to cash out the seller or pay off your balloon. That's what's going to be really important.
Agreed. Yeah, for sure. I mean, in my eyes, and you tell me if you agree with this, like, the bigger your down payment, then the longer time frame you need, because you don't want to be like, oh, I'll pay your balloon in 12 months, and it's like you owe $150,000 in 12 months, and the house hasn't appreciated $150,000 or something.
Yeah, like, for an example, I'm looking at a duplex right now in Central Mass. Sellers, they were long-term loans, just free and clear. Like, my offer I made as a starting point, and I don't know how much wiggle room I want to do, but the property's worth like $800,000 or roughly $800,000. So I said, all right, I'll give you a price of $799. But I'm not paying a high interest rate, because I'm not gonna be able to cash flow this thing. We can only rent each side for like $2,400. So my monthly payment needs to be like $2,500. Mm-hmm. So principal only payment of $2,500. I think I put 5% down or 7% down on it, and a 60-month balloon at least. So, because I knew, like, if I paid $2,500 over the course of 60 months, I'd pay down like $100,000.
Yeah.
So even if I'm not making a significant amount of money, like, I'm protecting myself basically 10 to 15% if the market drops.
Just with that principal pay down. Yeah.
Just with the principal pay down. So there's just some of those techniques that you can go about. I would say the biggest thing with creative financing is it's not osmosis. It takes time. And I don't want that to stop somebody. You have to start somewhere. So you're not going to have all the knowledge you're going to have at the beginning. Unfortunately, nobody does. But you need to start somewhere. So that's why I always tell people, like, maybe start with a lease option. Or if you have a good opportunity with a sub-2, do it. Or owner financing, do it. And it might not be the best terms of all time, but you have to get a deal. You have to invest in real estate to be a real estate investor.
What it also has to be, I always like to say, I like to create win-win scenarios. It can't be a win on one side. So, like, let's say this seller of this $800,000 property that you were just mentioning, if he's getting the price that he wants, he's getting the length of time that he wants, and he's also on top of that getting an interest. It's like, all right, where is Zach winning in this scenario?
He's not.
So there's got to be at least some give and take, right? You can't get all of those three things and then expect me to, like, I need to make money on this deal for it to make sense.
Yeah, or I don't give them like, so then you navigate, right? I always ask people, what's most important to you? Is it price? Is it down payment? Is it interest rate? Is it time frame? Because I can get you your win. I just can't give you them all. So there has to be flexibility. So if it's like, well, if I'm going to finance you, I want a higher price. All right, well then I don't want to give you as much of a down payment, or if any.
Yeah.
Because now I'm getting you your price and I'm getting it to you in a shorter time frame. So now you gotta let me. I gotta make money on this thing. So,
yeah.
Or I want to
I
hire.
always use the analogy we're pulling levels, right? So if you pull the bigger down payment, then that
Yeah.
means monthly payment goes down, and vice versa. You want a bigger monthly payment, down payment's got to go down. It's like we're pulling levels. So
100%. Yeah. Or purchase price versus time frame. If he doesn't want to do 60 months, all right, well then I need to be way more relevant with the purchase price, because I don't have the time to pay down debt, and I also don't have the time to let the market appreciate, because who knows if that's going to happen.
Yeah.
So lots and lots of different things you could do. That's why I always tell people there's more choices, and that's what stops people from doing creative financing, because you have more options. But that doesn't mean it's more complex. It just means that you have to understand what options to use and when.
100% agree. Zach, in what ways are you seeing lease options continue to be like a valuable strategy in today's real estate market?
Well, I think we covered a whole bunch of it, but there's a lot of creative financing in general is extremely valuable in today's market, even more so than most other markets have been. And I say market, I mean like time frame, not necessarily place or location. Mm-hmm. You have high interest rates, so the amount of people that can afford properties is nil. It's very low. And the affordability of properties is continuing to go up. So you have interest rates that are going up and the price of homes are going up. There's no balance.
Yeah.
The amount of people that can actually buy a house are significantly low, which means that the amount of tenant buyers or people that need a qualification like a rent to own program are going up. So this is a time frame in which both our buyers and our sellers are going up. So those are going up. And because the amount of people that can actually qualify for loans are going down, that means that the properties are sitting on the market longer, they're expiring more, sellers are not able to exit out of them as quickly. So now you have more expired listings, you got more people with challenges, you have taxes that are increasing significantly because during COVID, the purchase prices rose so fast that the tax assessments are just coming out now. So now you have this affordability issue for the people that even own the assets or the piece of real estate. So now they need more people in the creative financing space to bridge that gap. And that's just in residential. I'm not even talking about, seller financing and subject to deals in commercial and multifamilies, because commercial loans right now are insane. Plus you have a significant amount of loans coming due right now, which I'm sure is going to start dropping prices on multifamilies, because everybody had those 5-year arms right now, which is going to be interesting, right? So obviously some cash offers are going to be coming even more and more into play, or private money. And so now in commercial space, like it's almost impossible in a lot of these scenarios. We just used the duplex, for example. And that is, if I went to go get a traditional loan today on that property at 7%, that thing, I'd be negative like $2,000 every month. Like you can't buy that. And that's why that house is sitting on the market so long. Because that seller either needs to dump their price in order for someone to want to go get a loan for a certain property, so that way they can at least break even.
Yeah.
Or the seller is going to have to go a route like this, which is they have to be flexible on the terms, so that way they can actually get the price they want. Because I'm the only person that could probably pay their price, because the only other option is they get a cash buyer, and that cash buyer is going to dump their price. So there's so many. If you just look at all the nooks and crannies and keep pulling up all the rocks, there's so many scenarios right now that need to be filled with us. And that's why I tell people, like, if you're going to learn creative financing, like, just do it now. Like you have to. Like you're missing out if you don't.
Agreed. So what is some key things that you need in your business right now? I'm assuming more deals. We always need more deals, right? What else do you need in your business?
Yeah, I always tell people you want to control two things, right? You want to control the deal flow, and you want to control the money in the business. So, because if you have lots and lots of deal flow, then with lots of deal flow ends up coming either overhead, one, or two, is like referral fees and stuff. Like people don't do things for nothing.
Yep.
So I have chosen to tap into a lot of people like yourself or other networks where people would rather sell off these deals. So now you just got to control more money. And that certainly comes from raising some private money and things like that. The main other thing is you got to have talent, just like in any business, because creative financing is not osmosis. You got to find that balance of people that are hungry, want to learn, or have the real estate experience and want to participate in something bigger instead of just doing deals on their own. Because like somebody like myself, like if it would take a lot for me to want to go do deals with a group of people, like I would have to see a much bigger picture, much bigger win, a team goal, something significantly bigger than I could accomplish on my own. So I know that. So it's all about attracting the right people on your team in order to go out there and get after it.
I love it. Zach, where can people find more about you?
Yes, you can find me on social at Zachary Beach Official on Instagram or Zachary Beach on Facebook. If you want to follow our company, Smart Real Estate Coach, you can find us on all the social media platforms at Smart Real Estate Coach as well, or smartrealestatecoach.com. If anybody wants to actually read our first Amazon best-selling book, I know we gave out a whole bunch of them at the last event.
Prepared. Sorry about that.
That's all good. We just got to go to wickedsmartbooks.com. Wickedsmartbooks.com. Go ahead and grab it. I'd love to interact with you. Always looking to do more and more deals with people, or if you're looking to start your own business, our community would be an amazing place for you to get started.
Perfect. Zach, I am definitely looking forward to networking with you more. I want to do some deals together. I want to get involved in some way, shape, or form. It's like I told you, we were on the phone the other day. It's like I actually like fixing and flipping because I like taking a disgusting property and making it look beautiful. I like that process. But at the same time, I'm looking at what you're doing and I'm just like, this is something I can get behind. I want to get involved with because you have just like multiple streams. It's like from the initial non-refundable deposit to the potential monthly cash flow. And then down the line, like it's like you're creating win-wins everywhere because you're also helping perpetual tenants become homeowners, which is something a lot of them have never seen themselves doing. And then you're also getting a win out of it because you're getting the price that you wanted. So I just see it as a win all the way around.
For sure. We're always going to find ways. We'll find ways to do some deals together, my man. I appreciate you having me on.
Yeah. Thank you for being here. Thank you for your time, man. I'll talk to you soon.
All right. See you, everyone.
All right.